Welcome to Options 101 Terminology and Basic Concepts, Part 8, brought to you by TradeRightly.com. In the last episode, we took a look at, we introduced the terms of intrinsic and extrinsic value, and now I want to take a closer look at extrinsic value by itself. And we said that extrinsic value is determined by time and volatility, and we're going to discuss each one separately. Now, time value, shown here by the declining purple area, recognizes that the option writer is exposing himself to potential losses for the life of the option and is entitled to a degree of compensation for it. As the option gets closer to expiration, let's say this has got the option is 7 days away from expiration, the probability that he's going to get assigned is reduced. And as a result, the time value declines. Now, I've shown the decline as a straight line, but in actuality, the time value rate of decline is affected by the option's moneyness, how much it's in the money. At the money options are going to hold their value in the early part of their life fairly well, and then they're going to decline really rapid. It looks something like this. The line would come here, and then it would really fall off. Sorry, my pointer went crazy there. It would really fall off as you got closer. So the straight line is just to give you an idea that these things, it declines over time, but it's not a linear rate of decline the way that I'm showing here. It varies depending on the option. Regardless of that rate of decline, it's really only important that we understand the clock is always ticking, so time value never goes up. It's like buying a new car. The second you drive it off the lot, it's worth thousands less, and the value keeps degrading every mile you drive it. Now, while time value is making its steady progress towards zero, the total value of an option, the total value might go up and down as the market fluctuates. So this up and down of the total value is, that up and down is part of the extrinsic value. So the time value could be going down, but the total price of the option might go up based on what's happening in the market. If the market is very volatile, the extrinsic value of that option more than makes up for the decline in time value. And so the total value of the option, what it's actually priced at, might actually go up as time goes on. But overall, no matter what's happening during market conditions, when this thing expires, it's worthless. So we were talking about volatility. I think time value is pretty easy to understand. As time goes on, value goes down. But volatility, what really is volatility? Well, volatility, it measures the amount of change in the price of the underlying. So if the price is fluctuating wildly, then volatility is high. If the price is only moving up and down in small increments, then volatility is low. Volatility is measured in two ways. Historical volatility, also referred to as statistical volatility. It's pretty straightforward. It gives us an historical record of what the volatility actually was in the past. Implied volatility, on the other hand, is a forward-looking measure of what the market believes volatility will be. And because volatility has a strong effect on the value of options, knowing how the volatility of an underlying is likely to move is a key determinant in how we make our trading decisions. Now, I know at this point, if you're a complete beginner, we're pretty in depth into some concepts that probably don't make sense to you. But what I want to encourage you to just stick with the education. I'm giving you building blocks. As I said in the beginning of part one of this thing, a lot of this stuff is going to end up being background knowledge. And what I would suggest is when we get further into the education, we start showing you examples, how you pick these trades out, you'll start to remember, we'll talk about volatility and how that's determining why we're making a decision. And at that point, you may say, you know what, let me go back to that Options 101 course and just look at those definitions of volatility to get a more concrete understanding of what we're talking about. Or when we're actually there, giving those examples and showing you how you're picking out trades, just the discussion of volatility that's incurred here might give you enough of context so that why we're making those decisions to pick certain trades make a little more sense. Okay, so let's take a look at, why do we even need to understand how options are valued? And the reason is this. In simple terms, if we believe option values are going to go up, we're going to pursue buying strategies. If you remember from one of the previous episodes, buying to open a position is considered a long position. So if we think that option value is going to go up, we're going to buy. Well, it makes sense to buy an asset that is likely to increase in value, right? The other side of that coin is that if we expect values of options to go down, we'll pursue selling strategies, going short. When we sell an option, we are essentially betting that it's going to expire worthless to the buyer, and we're going to get to keep what we sold it for. The quicker it moves towards worthless, the happier we are. This is why we sell when values are high and are likely to fall. And that's it for this episode of TradeRightly's Options 101 video series. For more information on how you can beat the pants off the market, visit TradeRightly.com.